Hi, this is Ed Weinberg, and this is the Beginner Real Estate Conference Call. You can find us on Meetup. You can also find announcements of this on the the Facebook group CTRE Investors. So why don't we first start by going around and introducing ourselves. My name is, again, Ed Weinberg. I am an investor. I've been investing in real estate for quite some time now. And I am also a real estate agent with Keller Williams in Trumbull, although as a real estate agent I can be an agent to buy and sell houses anywhere in the state of Connecticut. So who else do we have here? George, would you like to introduce yourself? Tell us what you do, where you do it, and if you support real estate investors in some way.
Is that Jorge or George?
I'm sorry, Jorge. I wrote down George. I meant Jorge. Go ahead, Jorge.
Actually, it's George with a J.
Right. Okay,
well,
I spelled it wrong. And
right.
I spelled it wrong, pronounced it right.
That's correct.
Go ahead, Jorge.
Okay. Anyway, thank you, Ed. We're friends, and you were my sponsor at Keller Williams. I'm an independent real estate broker, licensed in New York and Connecticut. But basically, I have a private funding club for investors. And we do joint venturing, church loans, investor loans like fix and flip. And then the second company I have is a solar energy company for residential and commercial solar. And that's basically it. We're nationwide, and I've been in the real estate and finance field not long, 37 years, 6 months, a couple of weeks, and 47 seconds and counting. And I started the solar business about a year ago, and it's been gaining traction. And I live in Bridgeport, and I plan to stay in Bridgeport. I came from Florida, was there for 10 years, and so here I am. Thank you.
Okay. Great. Thank you, Jorge. Melanie, what do you do and where do you do it?
Hello. Well, I'm very new to real estate investing. I currently have a 3-family house in New Haven, but I plan on getting more into rehabs and flips, which is why I was interested in this meetup to learn how to get more funding. I'm a part of 2 groups. I have my own investing company that I started up. I haven't done my first deal yet, but hopefully that'll be soon. And then I'm a part of another group in Bridgeport where we're looking more into commercial mixed properties. So I'm listening in for them as well, just to see what our options could be.
Okay, great. So just as a quick introduction, well, this is Joe Zaniboni. He's from Grand Coast Capital. And why don't you tell us a little bit about but why don't we first talk about what a hard money lender is and what kind of loans they give and how they qualify people and properties, and then you can tell us a little bit about your company. Go ahead, Joe.
Yeah, absolutely, Ed. Thank you for the introduction there. Looking forward to chatting with you guys today a little bit about hard money lending, but what we call, which essentially is what hard money lending is asset-based lending, right? Which is simply a form of lending where the primary collateral for a given loan or debt obligation is a hard asset. In our case, it's real estate, right? So that is what I do over at Grand Coast Capital. We're a national lender by industry standards. We would be considered a hard money lender, and our primary product that we offer, and we work with investors nationwide to provide them with short-term renovation capital for their fix and flip deals. So that's what I do. I'm a loan officer for the company. I've been with Grand Coast for going on just over 3 years now, but I've been in real estate for a few years prior to that. Also studied real estate in my undergrad, in my bachelor's degree at San Diego State. So been in real estate for some time now, and actually prior to my experience here with Grand Coast Capital, I worked as a acquisitions team member for CT Homes. I don't know how many of you guys are either fortune builders, students, or are familiar with CT Homes, but they are actually formerly Connecticut-based. So you may have heard them. They've been on the show, flipped this house back in 07, 08, I believe, in the formative years of the popularity of that show. So I had a chance to work with that company for a couple of years while I was finishing up my bachelor's degree and served as an acquisitions team member. So I've been on the investment side as well as the lending side. I also have my own company with my father. We flip houses as well. But my primary role right now, like I said, I am a loan originator or loan officer for Grand Coast Capital. I've done just over $55 million in origination for single-family or 1 to 4 unit residential homes for investment properties, and I've underwritten over $100 million in real estate transactions for residential real estate. So looking forward to chatting with you guys. It sounds like we've got a smaller group here, so I'm definitely up to keep it, open and conversational, and, looking forward to talking with you guys. And if anybody wants to jump in with any questions while I'm talking here, we can definitely do that. But yeah, that's it for an intro for me.
Okay, so Joe, just your description of how you qualify a loan, you're doing it basically on the value of the property, because that's what asset base means. Is that correct?
Absolutely. So there are multiple things that or criteria that we look at as a lender or as an asset-based lender, renovation capital lender, or hard money lender, whatever you want to call it. But the collateral or the asset, in this case the real estate, is our primary focus. Yes, absolutely. And so when we're looking at any given loan opportunity, the first thing we want to understand is this deal going to be profitable for our borrowers, right? There are a lot of lenders out there that don't necessarily care whether or not you're making a profit on the deal. Because all lenders lend at a discount to either the cost or the value of the property. So in all likelihood, they're typically going to be protected. Whether you break even, make some money, or lose a little bit of money, they're typically going to be okay. We don't operate that way. We're trying to build long-term relationships with all of our borrowers, and we do that by ensuring to the absolute best of our ability that we are putting you into a good deal when we fund one of your deals. So yes, the primary focus for us when we're working with investors who are flipping is to make sure that the deal itself is profitable, and there are a number of criteria that we look at in order to do that, which I'm happy to get into with you guys.
Okay, so if I'm going to buy a piece of property, when I purchase it, there's something that you guys call loan to value ratio. Now,
yes.
What loan to value ratio are you typically looking for, and how much, and have the original purchase, and what kind of percentage would you like the borrower to be putting down?
Sure. So that touches on the capital aspect. The way I like to kind of explain how a hard money lender works, and what we look at is by using what I call the 4 C's of credit. Obviously, I didn't coin that term myself, but I like to use that because it applies to every aspect that we look at in a given loan opportunity. So the first one we talked about, or the first C, was collateral, right? That was the real estate. That was the property itself, and we'll jump back to that in a second. But your question, Ed, is in regards to the second C, which is capital, right? So every lender will provide a certain percentage, like you mentioned, of the total cost or of the total value of a given property. So the key is to first understand what that lender's criteria is, what the maximum amount they will lend is, and then to figure out if the lender is providing me with X, I need to make sure I'm covered for the difference, right, which includes a number of costs, right? So just to break it down for you guys and to get into a couple of metrics that you just touched on, Ed, that are very important for everyone to understand. We look at things like loan to value, or LTV for short, and loan to cost, or LTC for short, right? So loan to value is simply your loan amount as a percentage of whatever the projected after repair value would be, right? So just to repeat that, it's your loan amount as a percentage of the projected after repair value. So the formula for LTV to calculate that is just your loan amount divided by your after repair value. That'll give you a percentage, which would be an LTV number, right? The next one is loan to cost. So rather than your loan amount as a percentage of the total value, this is your loan amount as a percentage of the total cost of the project, right? So the way we look at total cost is simply your purchase price plus your rehab costs. That's your total cost, okay? So the formula for that is just your loan amount divided by that sum, the sum of your purchase and rehab costs. So that's loan to cost, and that's loan to value. And so each lender has a maximum LTV and a maximum LTC at which they will loan. So, for example, here at Grand Coast, we have a maximum loan to cost, and I like to focus on loan to cost, and I'll tell you why in a second. But we focus on loan to cost. So we have a maximum loan to cost of 80%. So Grand Coast will lend up to 80% of the total cost of your project.
Okay, so that total cost includes both the acquisition cost and the cost and the fix up plus the fix up cost.
That's correct. So just to break down just a super easy example for you guys, let's say the purchase price is $100,000, right? And we've got rehab costs of $50,000. Our total cost on that project is $150,000, right? So if Grand Coast is lending 80% of your total cost, we just take that total cost of $150 multiplied by 80%, and we get $120,000. So when you're doing your deal analysis, that's what you want to plug in, right? So to assume that Grand Coast will do 80% of whatever my total cost is, in this example, we get $120,000 as our loan amount. So you can see here now the way that breaks down, and here's where folks, especially newer folks, may sometimes get confused. It's about the allocation of that total loan, right? So how much is going towards the rehab, how much is going towards the purchase, what's my down payment, etc. So we take that $120,000 loan, right? And Grand Coast, we're always going to cover the full rehab. Whatever the rehab cost is, we're going to cover 100% of the rehab. Lenders typically like to cover the full rehab because it allows them to kind of stay in front of the progress on the deal and to make sure that they're never funding ahead of any value that's being created, if that makes sense.
So if I can just get a clarification here.
Sure.
Although we're putting in, you're going to only loan was it 120,000 or 125? I don't remember.
120, yeah. So that's 80%.
Okay, so you're going to loan
100.
Cost. You're going to loan 120. So when we purchase it, you're going to have a check ready for 80%, which would be $80,000 in your example. And me, I'm an investor. I'm going to have to bring $20,000 plus whatever closing cost there is to the table when I close. Is that right?
So no, actually, let me break this $120,000 loan amount down for you. So again, like I said, we're always going to cover the full rehab cost. So if you remember, in this example, if we have a loan amount of $120,000 and we've got rehab costs of $50,000, and Grand Coast is always going to cover 100% of whatever the rehab costs are, $50,000 of our $120,000 loan amount are going to be set aside and issued to the investor or the borrower in draws as work is completed on the rehab aspect of the property. So if we've got $50,000 of that $120,000 allocated towards the rehab, any remaining balance after that is going to be applied towards the purchase price. So in this example, $50,000 towards the rehab leaves us with $70,000 to be applied towards the purchase price. So in this case, you got your purchase price of $100,000. We're funding $70,000 on the purchase, so your down payment would be $30,000 or 30%.
Okay, so I'm putting down 30%, but after I put down that 30%, I'm going to have a draw. So are you going to give me the money in advance, or let's say that we break it down into the 50,000 down into 3 different sections and 3 different milestones. Am I going to get the first milestone, or do I have to do the work, front the money myself, and then get the first milestone from you after I finish the first milestone?
Sure, that's a great question, Ed, and that's why when we're underwriting any given deal, we always want to make sure our borrowers have some level of cash reserves available, because the way it works for most lenders, as far as national lenders go, or renovation capital lenders go, the draws are reimbursement for work that is completed. So you would have to float some of those initial costs. Or, of course, once you're in the business for some time, you've got good relationships with your contractors, maybe they're willing to complete some level of work and know that the payment is coming shortly thereafter. But if not, yes, you would be floating some of the purchase of the materials and some of that initial labor before we're able to reimburse you. Now, the size and timing of each draw is totally up to you. So the draws can be as frequent or infrequent as you want. That's totally up to you. But yes, they are paid in arrears, which is how most construction or rehab lenders operate. Now, the one caveat to that is that we can reimburse up to 50% of material purchases as long as we've got receipts and invoices and those materials have been delivered on site. In that case, we can reimburse up to 50%. After that, all the funds are coming after work is completed.
So if I'm getting a loan from you, I have to. You would probably want to see sitting in my bank account enough money to fund some of the enough to get through the draw, and also enough to pay you interest for the total length of the loan, term of the loan. Did I lose you, Joe?
Hey, Ed, sorry about that. I think I got disconnected there.
Oh, okay. All right. So we're going to need enough money if we want to do this project. We're going to need enough money to put down to close on the house, and then afterwards enough for the draw, and we're also going to need enough to pay the interest on the loan.
That's correct, yes. So we look at all those things. So when we're underwriting a given deal, and that kind of ties back to the second C of credit that we're talking about here, which is capital, right? So once we've got the loan amount figured out, the key is figuring out that remaining piece, right? Outside of Grand Coast, outside of our loan amount, how much cash is the borrower responsible for? How much cash is the borrower putting into the deal? So this is what we call your borrower equity or your skin in the game, right, so to speak. So this includes the down payment that we talked about, which in that example was 30% or $30,000, right? And it also includes things like your closing costs, right? Title and escrow fees, things like that. It includes your points or commitment fee or origination fee. These are sort of interchangeable terms that you might hear, but they all mean the same thing. Points are a percentage of the total loan amount that a lender charges, and it's due up front when the loan is funded. So for Grand Coast, for example, our points typically range from anywhere from 2.5 to 4 points, or 2.5 to 4% of the total loan amount, and that's due up front. So that's another closing cost, right? And then you've got your carry costs throughout the term of the loan. So you've got interest payments, of course, right? You've got taxes, insurance, utilities. These are all things that a lender is looking at and projecting out into the future, however long the projected term is, whether that's 6, 7, 8, 9, 10, 11, 12 months, whatever that is. They're projecting those costs for the length of the entire term, and they want to make sure that you as the borrower are covered for all of that, right? For your down payment, closing costs, carry costs, everything throughout the entire term of the loan. So yes, those are all things that we look at. Now, one thing I will say real quick, Ed, here is there are a lot of lenders out there where you as the borrower would be responsible for covering all of that yourself. We are okay with you as a borrower using private money lenders or second lenders to come in a second lien position and kind of help you bridge that gap between our loan amount and all of the funds that you'll need for the deal, for not only your down payment but all of your other costs as well.
Okay, and there's one other question that I've talked to, and by the way, and I know that this is also something that varies from lender to lender. Some lenders will charge you an extra point if you go over 6 months with the term of the loan, and you don't sell it in time. How long will you allow us to use this money?
Sure, good question, Ed. So we have at Grand Coast, we have uniform term of 12 months on all of our loans. Now, the length of the term does not affect anything as it relates to the pricing on the loan, whether, interest rate points or any of that. So it's a uniform 12-month term for all of our loans. So we are seeking to get into or lend on deals that are obviously relatively quick turnaround, right? We're not looking to get into 2-year, 3-year projects. These are all single family or 1 to 4 unit flips that we're focused on. So typically 12 months is more than sufficient. But one thing I will say about that is there's no prepayment penalty for early repayment. So now you do have to make at least 3 months worth of interest payments, but let's say we do a 12-month term and you finish and sell the property in month 5, at the end of month 5. You will have made 5 interest payments, but you're not going to owe any interest for months 6, 7, 8, 9, 10, 11, and 12. You simply repay the principal balance at the end of month 5, and that's it.
Okay. So now, as I said, there are others that I've heard of that I've spoke to that basically want their money back after 6 months, and if they don't get their money back, they want a point. I mean, they don't care. I mean, you can pay them a point or something like that, and you can keep the money for another 6 months. But I guess that most of us, when we're doing a flip, what our expectations are is that it would take somewhere between 3 and 6 months to purchase it, put it together, and find a buyer. But of course, it could always go over to a 7th or an 8th month, depending on how good a buyer you find the first time, and if the first one actually gets the loan to buy it. So that extra cushion is certainly something that I'd like to have and not have to pay an extra point on. It's a little bit of a load off my mind.
Yeah, we've learned over time, Ed, and it wasn't always that way. We used to have 6-month term, 9-month term, and 12-month term options, and obviously the shorter term meant more favorable pricing. But we scrapped that and just went with a uniform term that has zero impact on our pricing. The reason for that is because we've learned over time that borrowers tend to underestimate the amount of time that they think it's going to take them to purchase, rehab, and sell the property. For the most part, it takes at least a month or 2 longer than our borrowers typically are projecting for a variety of reasons. So we're always going to be conservative in the way we underwrite a deal. And let's say a borrower thinks that they're going to be in and out in 6 months. In all likelihood, we're going to be projecting at least a 7, 8, maybe even a 9-month term. Of course, depending on the market, what we're seeing for days on market, as well as, the size and scope of the rehab project itself.
So let's just 2 more things, and then we'll take questions from people.
Sure.
The main thing you're looking at is the property. What kind of, are you going to look at the FICO score of the people doing the work? I'm sure you're going to look at their experience, but are you going to also, if they're, say, a new investor and haven't done one before, or this is the first time they're doing a deal with you, are you going to look at their credit report? And how critically are you going to do that?
Yeah, that's great, Ed. And again, that flows perfectly with our theme here of the 4 C's of credit, right? Because the third C, so first we had collateral, which was the deal itself, which, by the way, there's a few more tips I want to be able to give you guys on that, but we'll jump back to that in a minute. We've got the collateral. The third C is capacity, right? It's basically, do you have the experience and or level of competency, right, or wherewithal to successfully complete this deal. And there are a number of things that go into that we look at and that are a part of our criteria. You mentioned a credit score there. You mentioned experience. So I'll touch on experience first. So obviously having a track record in real estate, particularly in doing what it is we're lending on, so flipping houses, having an established track record and deals under your belt is a good thing, and will help you not only to secure an approval, but also can favorably impact the pricing that you may get on a given loan. But with that said, we also lend to plenty of first-timers. So I don't want to discourage any folks that have not, that are still working towards that first deal. And we also give you the opportunity in our application to give us any information that you have on any general relevant experience. So it doesn't necessarily have to be real estate related. There are a lot of transferable skills from various industries that we consider very relevant to what we're doing here in real estate. So not to mention a track record of success somewhere else in some other field in a lender's mind is an assumption that you will be successful in what we're doing here, right, in real estate. So yes, experience is something we look at. It's not necessarily a deal breaker, but it's something we look at. Credit score was the next thing you mentioned there, Ed. That's something we look at as well. As far as the importance level of that, I'll say it doesn't rank at the top. It's something that we look at, but it's really just a piece of the overall puzzle of this deal profile that we're looking at. We officially have a minimum FICO score of 640, but I will say we frequently make exceptions to that. The key is to just find out, if the score is below 640, what is kind of the story behind the score and what's been done to repair that credit score in the meantime. Again, I don't want to discourage anyone that has a score below 640 not to submit because we fund plenty of deals for folks that have those lower scores. The pricing may be impacted a little bit, but we can certainly work with you.
Okay. And I guess one last question. Supposing I've got some extra money and I want to invest, or I want to invest using my IRA that's got some money in it, what's the minimum that you would take as an investment, and do I have to qualify myself to invest with you?
Gotcha. Okay, so you're talking about our investment fund here, just to make sure I'm clear here, right,
yes,
Ed?
That's correct.
Yeah, so that's a good question. So we do have, for folks that are interested in, a truly passive investment, we do have a fund set up, and that is our primary source of capital to be able to go out and make these loans. Is we raise capital from accredited investors, right? We are an SEC licensed and managed fund, so as a result, we have to follow SEC stipulations. That's the Securities and Exchange Commission. So the first requirement to be able to invest into the Grand Coast Capital Fund is to be accredited. Now, what accredited means, that essentially it's $1 million net worth excluding your primary residence, or $200,000 annual net income for 2 consecutive years with the expectation for that to continue. It would be $300,000 if you're filing taxes jointly with your spouse. But if you think you meet that accredited criteria, and again, that's an SEC criteria, not something that we're in charge of. That criteria is put in place to make sure investors are protected, right? So, but yeah, if you do meet that criteria, you can certainly invest into the Grand Coast Fund. We have right now the opportunity is for our second fund, which is actually it's a commercial equity fund that we've recently opened, which we are purchasing commercial properties throughout the country and even some abroad. The returns that we target for our investors is 12 to 15%. Now, you mentioned investing through your retirement funds. That is set up a little bit differently. And to be totally honest with you, Ed, my focus, I am a loan officer for Grand Coast. We have investor relations team members that kind of help us do fundraising for our fund and focus on that aspect so they can get into a higher level of detail. As far as the investment criteria, and the returns you can get by investing through your IRA. But I wouldn't be able to speak too accurately on that right now. So.
Okay, that's good. So thank you, Joe. Does anybody have any questions?
Yeah, happy to go through any questions that you guys have. I know, we could cover another hour here of just me talking, but I figured any questions that you have, I'm happy to clarify.
I have a question. Do you have a minimum loan amount that you use?
Yeah. Great question. Yeah, so we have a minimum loan size of $100,000. We go all the way up to $3 million. So the key with that minimum loan size is you want to look at the total cost of the deal and make sure that 80% of the total cost equals or exceeds $100,000. Does that make sense? So basically, your total cost on a given deal would need to be between purchase and rehab costs. However that's allocated between the two, you want your total cost to be at least $125,000, $130,000, because 80% of that would put us just at that minimum loan size of $100,000. So good question.
Okay, and of course we're in Connecticut, where it's still where you can find houses that are less expensive, but but they're not. There's not a lot of them. Go ahead.
Yeah,
I'm sorry, I interrupted you.
Meeting that minimum criteria is certainly easier for folks along the coast in both east and west than it is for folks in some of the more centralized parts of the country. So it's all relative, I suppose.
Okay, and by the way, I've had requests from both the Facebook group and from the group that my real estate company has to put a recording of this up so that other people who couldn't make it could hear it. So I hope you're okay with that, I assume, Joe?
Yeah, absolutely. And I guess I'm certainly open to take more questions too here, but two other kind of quick points. I know we're kind of jumping around here a little bit, but especially for folks that might be viewing this later, I want to make sure I can give you some tips to try to make sure, when you're doing your deal analysis that you're working on a deal that you think that might be in range as far as Grand Coast Capital's lending criteria. So like I said, we're very concerned with making sure that your deals are profitable. So we do that, number one, by making sure, obviously, that you have a solid budget, right, that's been confirmed by a general contractor that you're going to be working with. That way we can make sure we're underwriting an accurate rehab number. And then also, and most importantly, is the ARV, or after repair value, right? So we're a national lender, so it's impossible for us to have that same intimate local market knowledge that you guys have in every one of your markets. So as a result, we rely very heavily on sold comparable properties in the area to justify the ARV. So I could spend a couple hours talking about this, but just a couple quick tips for you guys as far as that goes. When you're looking at your comparables, a lender typically wants to see sold comps, right? They're not as interested in active or pending comps. They really want to see sold comps because that proves the market. And you want to be able to identify at least 3 or 4 of those. If you have trouble with that, especially a national lender, they may have trouble getting comfortable with the deal because they need to make sure that the data is there to prove the valuation. The other tip for you guys, you want your comps to all have been sold within the last 6 months. You can go out a year if you have to, but you really don't want to be going out any more than a year when you're looking at sold comps. Another good rule of thumb is you want your comps to be ideally within a mile of the subject property. Now, that's just a rule of thumb. It's not a hard and fast rule. What we're really trying to do when we look at that mile proximity rule is we're trying to zero in on the neighborhood, right, which is a little harder to define. But the proximity rule helps us get there. But again, it's not a perfect rule. You could have a subject property and then another property 300 yards away, but it's on the other side of, a set of train tracks, a river, a freeway, whatever it is, and it's a totally different neighborhood, right? So it's not a perfect rule, but it helps us kind of zero in on the same or comparable neighborhood. So those are just a couple of tips. Oh, last one, when you're looking at the comps, you want to see a low days on market, right? You don't want to be in an area where properties are sitting on the market for 3 or 4 months at a time, right? You want there to be strong velocity in the market, which basically just means that the properties are selling relatively quickly. So a good rule of thumb for that is when you're looking at sold comps is 90 days or less, ideally. Again, there are exceptions to that rule. Sometimes properties are overpriced and they sit for a while. It doesn't necessarily mean it's a bad market, but that's just a good rule of thumb to follow. So, yeah, just a couple tips on that.
Okay. Anybody else? Jorge, Melanie? I know Jorge's probably an expert at this already.
No, actually, you guys have covered a lot, and I'm familiar with Grand Coast because I'm a Fortune Builder student. So I'm hearing some of the things over. It's like a refresher, so it's good to go back over all of this information.
And I learn something every time, so never stop learning. Thank you so much.
Right on.
Okay. All right, then I'm going to wrap things up, and people who are here can leave me notes and give me suggestions on what you'd like to hear about next time. As I said, we're going to post this, and I'm not sure exact. Probably put it on a YouTube channel, and or on upload it to Facebook, and it'll probably be on the Dex Property Solutions Facebook page, and I'll probably share it from there to different places.
I was wondering, Ed.
Yeah.
I was wondering if I could share my email address so
sure.
The people here can keep in touch. I don't know if
sure.
that's appropriate.
No, go right ahead. And Joe, you want, if you want, you can give your contact information, and then we'll wrap things up.
Absolutely.
So go ahead, Jorge.
Okay, so it's Jorge, Jorge, at Global Realty Planners with an S.com.
Okay, and how can we find you, Joe? Yes,
so you guys can email me anytime at Joe, Z as in zebra, so just JOEZ as in zebra, at grandcoastcapital.com. Joe Z at grandcoastcapital.com. And then if you want to give me a call, you can always reach me direct at 857-403-1733. That's 857-403-1733.
Okay. I guess if that's it, we'll just wrap things up. This is the beginner real estate meetup, and we by the way, for everyone, just so everyone knows, the freeconferencecall.com tells me that they're going to change my number next month to give me better service, whatever that means. But basically, the number is going to change. It will be posted every place where the next meetup is announced. We meet on the first and third Thursday of each month. So we won't be meeting again until the first Thursday of next month, which is the 6th. So July 6th, which is Thursday. So I hope everybody has a nice week and find some deals. And maybe if you find some deals, next time you can tell us about them.
Happy Father's Day.
Thanks,
everybody.
And thank you, Joe. Have a nice day.
You got it. Bye-bye.
Bye.